Hello and welcome to the Weekend Investing Daily Byte of 9th of July, and the market continued on a upward trajectory. Today's discussion is on FnO trading. There are some new murmurs from SEBI's committee. We'll talk about it. Is the game over for retail FnO trading? First, a request from me and my team. Please do subscribe the channel if you haven't. Click on the bell notification and share these videos with your friends. Where's the markets headed? Nifty making a new all-time high. 24,433 is the closing after yesterday's and day before yesterday's nervousness a bit. Market came back very strongly, up nearly 0.5% today. The juggernaut continues to roll forward. Don't seem to be impacted by anything at all right now. Nifty Junior up also another 0.5%. Gap up, went up, closed the gap down, came back up, and has closed nearly 0.5% up. Nifty mid caps still from yesterday's open remaining sideways. Last 4 or 5 sessions have been good, so some consolidation is happening here. Mid caps not moving as much as large caps have been. And similarly for small caps, about a 0.25% gain, and the daily candles are just about sideways for the last 3 sessions. Specific pockets like yesterday, the railway stocks were moving. Today, autos were moving. Specific sector changes are happening. Bank Nifty dull and consolidating mode. Again, 0.25% up, but last 10 or 12 sessions have been in the same range. The push that one initially got 2 weeks back from private banks is no longer the driving force there. So I think every sector is now awaiting keenly on the budget, which is less than what 13 or 14 days away. And then, of course, quarterly numbers will start to roll in the next month. These are the two triggers going forward. Auto space, you can see buzzing today. Maruti, Mahindra, not Titan, Tata Motors, Hero Motors. Um, Good buzz there. Good buzz also in FMCG, Britannia, and ITC. Some pharma names were also going up. Banks totally silent except ICICI Bank. Reliance was down a bit. No other major movers within the Nifty space. In the Nifty next 50 space, rail stocks that were running very hard yesterday, taking some break today. So RVNL, IRFC, IRCTC, all these rail all stocks were down. The public sector enterprise stocks were also on a softer mode. You had Bosch, Havells, Siemens, ABB, Motherson gaining some ground, Adani Power gaining after a long while, LIC also gaining after a long while, and you had Zomato and Indigo also gain a bit for the day. Sectoral trends, autos leading the pack, 2.2% today. In the entire month, the gain is only 3.2%, and 2.2 of that has come today itself. So you can see that they were totally down and out, but today a new lease of life has been pushed into the auto space. Pharma also doing 1.6% today, good 5.5% this month. PSU banks coming back after a while, 1.3% today, and you can see on the monthly it's only 0.7. So the entire monthly gain, in fact, more than that has come from today itself. And on a 3 monthly basis, also PSU banks have not done well. Is this the turning point for PSU banks? Consumption stocks up 1.2%. Real estate after many days is also coming back. You can see entire week's gain has come virtually today, right here. FMCG has been doing well, 4.4% this week. And you also had IT stocks losing some ground along with energy, but IT stocks have done very well in this last 1 month, almost the second best sectors behind public sector enterprise stocks. Energy stocks also has done well over the past 1 month, but taking a break today. Auto index, after this brief correction from this mid of June, has now started to go back up and should challenge this previous high in coming sessions, 2.23% up. Pharma is one of the best charts right now where, post the election volatility, it broke out of this long-term resistance, took a retest of the same and has been flying very, very high. Pharma's index is doing extremely well. In the stock spotlight index, Maruti gained 6.6% today. It almost came into this resistance band around 13,000 on news that Uttar Pradesh has abolished the registration tax on hybrid vehicles. and Maruti's hybrid vehicles are quite popular, and this will probably uh, be a catalyst for other states to compete now. I mean, this is actually a very positive sign that a state has taken upon itself to have a new policy on hybrid vehicles. The center has been thinking about it, but the states have already, UP has taken a lead. Uh, Now, just imagine UP, if you buy, let's say, the Maruti, the SUV that they have, that's about 30 lakhs odd, and about, I think, 10% is the registration. So 3 lakhs is off straight away from that vehicle. Anybody in the neighboring states, Delhi or Gurgaon or other parts of Haryana, will now try to buy the car from there. So suddenly now there is a competition amongst at least neighboring states, and other states will also have to, match this offer. So it is very good when states compete for business rather than being fed subsidies from the center. I think this is a very positive news that has come from Uttar Pradesh, and I think it also shows the proactiveness of that government now in trying to push business forward. Maruti Suzuki has been on a roll since last July. We broke out of this long-term inverted head and shoulders pattern, which pretty much has a 15, 16,000 target over the long term. And this broke out in June, July, and a bit of a retest here, and then a consolidation. I think it can break out from this congestion zone if this picks up. Otherwise, there has been some sort of a slowdown in auto sales, and I think couple more months of weakness may be there before the festive season will take it up. Coming back to the main story of the day, so is it game over for retail FnO trading? Why are we saying that? Because the SEBI committee panel that was set up to study the FnO markets and to recommend strategies to improve the investor confidence, investor protection, and improve the risk metrics of this segment. That has given some proposals. There are proposals about. I'll go through those proposals, but basically the SEBI and RBI have been expressing concern over risks associated with retail investors in the FnO markets and the market volatility. And SEBI says that capital market has anecdotal evidence that people are borrowing money to place speculative bets in the FnO segment, and household savings are going into such risky bets, and 90% of the people who come into FnO markets lose their capital or lose at least some money. So Nifty options volume, for instance, have been going up dramatically last 2, 3 years. I've done several pieces on this earlier as well. There has been an options frenzy in India versus the rest of the world. You can see what's the kind of compounded annual growth rate of options contracts that are getting traded, and the entire world is baffled about what is happening in India. Some of these are international stories that were done on India as to how the Indian options volume, the ones in the red here, versus the US in the pink, how they've exploded in the last 2, 3 years. Equity derivatives explode in India. You just look at the daily turnover on the equity derivatives market. So nothing wrong with having more turnover, but somehow the regulators and the finance ministry as well are taking cognizance of the fact that there is a global sort of viewpoint on this, that what is happening in India. India is exploding in terms of equity derivatives, and household savings is the main sort of reason why the regulators feel that they should channelize the investments, the money towards the right direction. So some proposals that are in consideration is to increase the minimum lot size of derivative contracts. Currently, it is about 5 lakhs. So roundabout figure near 5 lakhs. Some contracts are 7 lakhs. Some contracts may be 4 lakhs, but they are nearest to 5 lakhs. That proposal could be to make them 20 to 30 lakhs so that retail cannot enter into that particular contract. So if a contract minimum, let's say one lot is worth 30 lakhs, and let's say the margin is 40%, so then you need at least 12 lakhs to even do one lot of trading there. So that may eliminate a lot of folks from that trading. That is the proposal in consideration. Another proposal in consideration is to restrict weekly options to only one expiry per stock exchange. So what every stock exchange, both NSE and BSE, are doing are competing with each other and are having expiries every day. There's a mid cap expiry. There is a CNX financial services expiry. There is a Nifty expiry. There's a bank Nifty expiry. It has become a expiry brokerage and transaction cost generating game for the exchanges. And why not? I mean, it is boosting their business like anything. So they have almost five expiries every week, and that could be restricted to one per week is one of the proposals in consideration. Then another proposal in consideration is limiting the number of strike prices for options contracts. So right now there is a strike price every 50 rupees, every 100 rupees on the Nifty or on the bank Nifty or in stocks. So if you limit the number of strike prices, so the intent probably is that if larger players are only in the FnO market, then maybe the smaller players will go towards more channelize their money towards investing, towards mutual funds, towards small cases, etc. So other proposals are consideration of fewer strike prices, upfront collection of options premium from options buyers. I think this is already happening. I'm not sure what is the proposal there. Intraday monitoring of position limits. So maybe the uh, the position limits on a stock broker level could come down basis this proposal, or increasing margin requirements closer to expiry. So this one would be, you start an ex contract, and every day towards as you come nearer to the expiry, the margin keeps on increasing, so that on expiry, uh, there's not so much of open interest left. That is one of the proposals. So overall, uh, these proposals sound a bit draconian to some extent. I think, and this is my personal view, I feel that in an open market system, in a fair market system, you should not restrict anybody from transacting the way they are transacting. In fact, all costs of transaction should remain minimal. Uh, Securities transaction tax, which was imposed in 2000, I think 4 or 5, by previous governments in lieu of long-term capital gains tax, was continued later on, and all kinds of taxation have been added on to the market transactions. So the costs of transactions are not low. To increase them by increase of margin, by exposure, would would probably mean that you're trying to get people away from the market, which should not be the case. I think it's a like a natural cycle. If people are losing money, they will automatically get out of the market. Uh, and I don't think it is the job of the stock exchange or the regulator to make sure that people go and invest only and not trade. Because one very key thought on these proposals is that liquidity is the grease of the market. So if you take away liquidity, if you take away the number of participants, you actually introduce friction into the market by measure of poor price discovery, poor liquidity in the markets, more impact cost in the market, lesser arbitrage available. So actually speaking, more the liquidity, more the number of people, it's actually good for the market. And I don't think on a risk basis the entire market system is at risk. I think the risk management has been beautiful. Despite all kinds of volatility in the last many years, our market system has been really robust. And congratulations to the regulator and to the exchanges for that. But to be selective and take away retail uh, from the derivatives market, in my personal view, is not fair. I mean, it's giving an upper hand to those who have the wherewithal to come into that market, and a trader who is a budding trader who wants to grow, will his or her journey would get cut short. So I think from all those perspectives, this is not fair. But one more thing I want to add is that this is only the very initial proposals in consideration. Once the panel submits these proposals, there will be a proper consultation paper by SEBI to the public. And when SEBI comes out with a consultation paper, they ask for public comments. At that point of time, if you are an FNO trader, and if you don't want these changes to happen, you must drop in an email at the consultation uh, link, which will come. And if possible, I will also share it when it comes. So public participation is very, very essential, and your thought process, unless it reaches the regulator. Right now, I mean, as far as I can tell, we've never had so much interaction with the regulator like we were having in the last, 1 year, since Madam Bush has come into the regulator's seat. So I think the sentiment is very positive from a perspective of communication. So the more the people will be able to relay their thoughts on the proposals to SEBI whenever the consultation paper comes out, I'm sure the regulator will take a view which is in line with what most people think and are suggesting. But these are initial proposals. Some of them don't look so good to me. Uh, but in the light of open consultation, I think we have a fair opportunity coming up. Do use that whenever it comes. Also, thank you for watching this video. Please do like and share this video if you liked it, and do subscribe to the channel. Thank you. Bye.